You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose and the Loose. I hope you're doing well on this Tuesday. I am a big fan of the low yield, high growth stocks, mostly because this is where I find the largest amount of companies showing a very strong dividend triangle. So strong revenue growth, earnings growth, and of course, dividend growth. But I get that getting a dividend every month, every quarter will help you go through the year, especially if it's a bad one. It kind of like recomforts you. It's kind of like a small message telling you, hey, Mike, everything is okay. You don't have to worry about anything. You got your dividend. You're in good shape. So I thought of doing a quick episode on trying to find companies with a strong dividend triangle, but with a decent yield. So this is the best of both worlds, right? So you have a yield between 2 and 5%, but you still have a decent growth on top of that. I did a complete newsletter at Dividend Stocks Rock for my members, highlighting I think it was 30 stocks or something like that, probably more than that. But today I want to offer you 3 of those that were part of that newsletter. So to do that, I actually started with the DSR stock screener. So the screener was super easy. I did a quick search with a minimum pro rating and dividend safety score of 3. So 3 out of 5, just like bare minimum in my opinion. So nothing bad, but nothing incredibly strong. Just okay, good pro rating, good dividend safety, and then a yield between 2 and 5% as well, along with a minimum dividend growth over the past 5 years of 5%. So I wanted to have a little bit of dividend increases. I wanted to have a company sharing a good yield, but not too heavy. So not a high yield, not a low yield, something that nobody would discard in their research if they are dividend investor on a broader spectrum. And you can do that kind of research too, actually, if you use the DSR Rockstar list. So that list is a smaller version of our stock screener, already pre-screened for companies that has a strong dividend triangle. So you can get it for free at moosemarkets.com/rockstars. So moosemarkets.com/rockstars. And if you download it, you put your name, your email, you're going to get it. It's going to be updated every month. And then you can apply the same filter. So filter by yield, minimum dividend growth rate of 5%. And then you can start looking at companies offering the best of both worlds. Among those companies, you will find MTY Foods. So MTY.TO. Yields around 3% right now. Interesting one. So what's the bull case for MTY Food? Well, it's a franchisor, and it franchise and operate over 90 different quick service meals. So it's fast food. You can think of Thai Express, Baton Rouge, Wetzel Pretzel. It's kind of funny because most of the fast food chains into shopping malls and food courts, many of those are owned by MTY Food. So they are mostly in Canada and US, and also a little bit of international. And one thing that they do is they grow through acquisition. So they acquire new brands, they run their playbook across those new brands, and they try to expand geographically at the same time. So far, they're actually doing pretty well after the pandemic. It was during the pandemic, of course, it was tough because most of their restaurants are not standalone properties. So that was incredibly difficult to have traffic into shopping malls and in food courts. Now that is behind us, the company is going back on track, good yield. So kind of interesting here. On the downside, because there's always a bear case, MTY Foods, as I said, mostly in shopping malls, which makes them highly dependent on consumer traffic, which is not exactly booming these days into shopping malls, right? So it's going to be a little bit tougher to grow the customer traffic. And if they don't get that, well, they're not going to be able to sell their food, right? There is also change in consumer preferences. So MTY Food will have to adapt some of their fast foods into a healthier version, trying to attract consumers that are trying to make healthy choices, which is quite a challenge if you're going into a food court these days. So that also plays a little bit against them. And of course, they have to manage with labor shortage, uh thin margin, heavy competition. So those are like the breaks into their business model. Moving on to the second one is Hydro One. It's a utility that has a knack for growth. 2.6% yield, so a little bit lower than MTY Food. The ticker is H.TO, that's it. And Hydro One is a regulated utility. 99% of its operation are in Ontario. Super stable, predictable cash flow, of course. Benefits from a monopoly in Ontario, the largest province. Great economy, great diversified economy on top of that. So very easy for Hydro One to run its playbook. It has like a clear path for growth, capital expenditure like 1.3 to 1.6 million per year through 2027. That should enable Hydro One to ask for a rate increase and grow their earnings per share 6 to 8% annually. So the plan is on the table. It's quite clear. The company is doing well. It's partially owned by the government of Ontario, so it has a good size and its bad side, of course. But the company shows a very strong dividend triangle. So for a boring business that is incredibly stable, recession resistant, Hydro One shows quite a surprising dividend triangle. On the bear case, of course, the first one is the fact that they operates only in Ontario. So if we have, like, for example, all that tariff wars that goes on, and if it crashes the automotive industry in Ontario, that is going to be a big hit on this province. Not so much for other provinces that don't depend that much on auto parts and automakers. So you can see that being established in only one province could have like an impact on the need for electricity. So they're really dependent on that. The second thing is, of course, because they are partially owned by the government of Ontario, there comes some kind of like political problems that could happen. So sometimes some decisions, some push from its major shareholders could come from a political agenda instead of for the best case for the company. Now, moving on to the last one, I just wanted to talk about banks a little bit. Of course, you could pick any of the big six. They're all in that category of great companies offering a good yield between 3-4%, a little bit more for Scotiabank, and then decent dividend triangle, decent growth. So an interesting one. Of course, I want to highlight National Bank in this one. The yield is the lowest at 3.55. Probably among the lowest. Like Royal Bank is probably around those numbers as well. The company is a lot smaller than the Big Five, of course, and 50% of its revenue comes from Quebec. So that's definitely like the biggest bear case is this. Highly concentrated in Quebec, smallest economies of scales for them, and there are ways to grow, such as like increasing their exposure to Cambodia by running Alba Bank. I mean, it's going great right now, but when you're trying to expand geographically, we saw that Scotiabank's not always the best case, so you have to be careful about that. That could hurt going down the road if the country does not go well. Well, provision for credit losses will follow, and we all know the story. On the bull case, though, for National Bank, the company has made a lot of smart moves along the way. So the acquisition of Alba Bank right now is a success. The acquisition of Credigy in the United States is also a success. And the latest one is the acquisition of Canadian Western Bank, which opens the door to so much cross-selling opportunities. So they expand in Western Canada. They were not present there. They are getting a whole new book of clients. A lot of them are actually business owners, 37 billion in commercial loans, which they will be able to offer them private wealth services, which was not part of the offer from Canadian Western Bank internal product offering. So overall, I think that National Bank is still positioned for a lot of years of growth. Of course, it's a smaller bank. It's going to move a lot more, so it's also going to be more volatile. Just have to be careful. But just wanted to highlight those three companies. So MTY Foods, National Banks, or any other banks, but I mean, this one was not a big find, right? And Hydro One at 2.6%. That's a pretty good one. If you want to do similar research, you can do it for free using the Rockstar list at moosemarkets.com/rockstars. You put your name, your email, you're going to get the updated version every single month. That is coming from a broader and more complex version of the Dividend stocks screener. All right, Moose, that's enough for today. Tomorrow, we are going to talk about Buffett. So don't forget to give me a 5-star rating on this show if I provide you any value. And tomorrow, we're going to talk again. So until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.